Well, we want to welcome you to our call today with Harold Gatlin, CPA and President of Gatlin CPA Group. The title of our call today is Tax and Accounting Strategies for 2015. And if you're not already a client of Harold's, he's a licensed CPA in Indiana and Illinois. Harold earned a bachelor's degree in accounting from Marshall University and has a master's degree in education. He is a member of the American Institute of Certified Public Accountants and Indiana CPA Society. And Harold is president of the Gatlin CPA Group, which has offices in Plymouth, Valparaiso, Maryville, and southern Chicago. And he services both individuals and business clients in the northern Illinois and Indiana, South Chicago region. Harold, welcome to the call.
Thank you very much, Jeff. I'm good to be here.
Great. We got a lot of information in terms of taxes and accounting. We're trying to get started here in the tax season. Where would you like to start?
Well, Jeff, a new year rings in a new set of tax rules, whether we like it or whether we do not. And today's discussion will center primarily on some of the individual changes within the tax code that take effect in 2015. It will also reflect on the 2014 year because there are some issues that while the calendar year is completed, individuals can still make changes that affect the 14 year up to the filing date of April the 15th of 2015. So let me just start into a few things here, shall I? The year that we have coming up here, one of the things that's been in the news almost every day is on the Affordable Care Act and the new rules that take effect in both 14 and those additional new rules that start in 2015. I will be as brief as possible on this, and even a lot of this is untested. But in 2015, the employer mandate starts to kick in. Right now, as we said, companies with 100 or more full-time equivalent employees must offer health insurance coverage to full-timers or pay a tax. And those full-timers are those employed at least 30 hours a week on average. Now, there's a good chance that this number will be raised. Starting in 2016, firms with 50 to 99 full-time equivalent workers will be subject to these rules. They're called pay or play rules, and the coverage will be expanded to dependents, including kids under the age of 26. But what they're doing, Jeff, is they're making the fines for noncompliance quite stiff. In 2014, there are requirements that said that you must have individual insurance. Most of that was when individuals signed up and they received a subsidy, many of them did, then they were asked questions and the answers were taken on an honor basis. They will be sent a form will be coming in the mail, and it's a 1095 form. And it'll be the first time that they will be getting that form, and in a lot of cases, people will probably end up just throwing that away, thinking it's just junk mail. But it is a very important form that they'll be receiving that applies to this Affordable Care Act, and it has complicated the issues with tax preparers like Gatlin CPA Group as we deal with these issues for the individuals in the upcoming compliance by companies. So the reporting of this work health coverage is going to be something that, as we discuss, that with each and every tax return that is performed, there are certain questions that have to be asked. And basically starting in 2015, the tax that is, they call it a tax going without insurance, is typically the greater of two amounts: the basic fine or an income-based levy. The basic fine is going to soar to $325 a person. That's $162.50. That's half of that for each family member under 18, with a ceiling of $975. And the income-based levy doubles to 2% of the excess of household income over the tax return filing threshold. I could go into a whole lot of numbers on this, but it's pretty hard to just verbally discuss all these numbers, and certainly for those that are listening today, I suggest you contact our office. We're glad to help you, or your existing tax preparer, and they should be prepared to, and I'm sure they will be, to answer these types of questions. Moving on, the income tax brackets for 2015 for individuals, they're just a little bit wider this year. Now, as you know, that the top-end individual tax bracket, there was one that's been added in the last year to 39.6%. If you're fortunate enough to have income over $464,000, then that would be the tax on the excess amount over that. Many clients are going to be in the wide brackets of the 25% tax bracket, which starts at $74,900 up to $151,200. If the taxable income is in that approach, you are in a 25% tax bracket. What that means is that an amount over the $74,900 is taxed at 25%. The next most popular bracket would be over $151,200, but not more than $230,450. That's a 28% tax bracket. And then the lowest is taxable income not exceeding $74,900. That's taxed at 15%. The numbers that I just provided to you were the merit from the married table. Okay, taxes are different if you're single, as well as being the head of a household, and you can those numbers are readily ascertainable if you want to contact our office. Each year, the government raises the standard deduction. This year, and again, we'll be talking marrieds, but it's $12,600. And that's the standard deduction for the standard married couple. Certainly after you get over age 65, that increases. And singles is one half of the $12,600, it's $6,300. So therefore, if you do not have itemized deductions that, for example, real estate taxes, mortgage interest, charitable contributions, and so forth, that exceed the $12,600 if you're married, then you would take the standard deduction. I also should mention that if you have, moving on to the high incomers, they will begin to lose their itemized deductions if they have over $284,000. I'm going to round off $310,000 for marrieds. Okay. So there is some reduction as your income goes up. Personal exemptions are increasing to $4,000 per person, so the person that's married and has 3 children will have 5 exemptions. 5 times $4,000 is $20,000. That will be reduced from his overall income in order to come to a taxable income. The easiest way to think of taxes is this for the listener. If you take all your W-2 income and your interest and dividends, and then basically, if you were to deduct your itemized or standard deduction, the standard is $12,000, and you deduct your exemptions, you can figure out real quickly your family size. If you have 5, that's $20,000. So your gross income minus itemized deductions, or the standard, minus the exemptions, is going to give you your taxable income. And that way you can determine what your tax is by going to one of the tables. Okay. There's an there's an alternative minimum tax that continues to be with us, and I will not get into the details of that today, but it does affect certain taxpayers, and its reach is sort of unpredictable, but they have preference items that create usually a higher tax. And so if there's any questions... I'm sorry, what was that? Okay. For the year going into 2015, the Social Security wage base increases to $118,500. This will be increasing $1,500 from the cap of 2014, and the rates have stayed the same. There is a Medicare surtax that kicks in when a couple earns over $250,000. Now, let me tell you how this works. Basically, if the taxpayer has again, we're talking married couples, $250,000 is $200 for singles. Okay. Above that, if you have interest and dividends, there is a 3.8% tax on that amount. Okay, so this is just took place, I think it was 2013 was the first year that this took effect. The other things that you would expect to go up, such as the Medicare Part B premium, if you're receiving Social Security, that's going up a little bit. It's $104.90 a month beginning in 2015. And the HSAs, health savings accounts, the annual cap on deductible contributions, that's going to inch up also in 2015. They go to $6,650 for account owners with family coverage, and $3,350 for self-only coverage. Folks born between 1961 can put in an additional $1,000 more. So, if you're wanting to maximize your health savings account, and you're married and you're over 50, basically, or I should say that you're born before 61, you can maximize by putting in $7,650. Now, basically, how can you set up an account? That can be done at the bank. It can be done through investment companies. But you do have to look. There are minimum policy deductibles. The minimum policy deductibles increased to $2,600 for family and $1,300 for singles. So if you have a deductible on your current health insurance policy that's below that, then you do not qualify to set up a health savings account. It's only if it's in excess of that. We won't get into deducting long-term care insurance premiums, but there are some benefits to that also. Let's talk a minute about giving you a lot of numbers so far and a lot to digest, and with just a few of these things so far. But there are constantly changing numbers each year because so many numbers and so many deductions and adjustments are tied to the rate of inflation, and that's what causes that. For savings plans, let's talk about retirement plans a little bit this year. The maximum 401k contribution goes up to $18,000 for 2014. Let's keep in mind that 401k plans, just like they're the same as a normal traditional IRA, is that they are tax-deferred investments. In other words, only when you take the money out will you be taxed. So your full $18,000 when it goes in is not taxed at the time you put it in, but when you take it out, it will be taxed at that time. If you have the ceiling, I should say the ceiling on simple IRA plans, these are basically for small companies. The total goes to $12,500, and if you're over 50 this year, you can contribute up to $15,500 into a simple IRA plan. If you have a defined benefit plan, you can make contributions based upon a salary of up to $265,000. For any that would like to put in up to over $50,000 and to shelter that money from taxes, current taxes, and you could do that if your salary was at that level. And the the pay-in limitation for such a plan goes up to $53,000. Let's talk about for a minute Roth IRAs and the phase out on other IRAs. You can continue to put money into a Roth IRA, but there does come a point where those contributions are phased out. When you have adjusted gross income between $183,000 and $193,000, that's for couples. Then after $193,000, the Roth IRA is you can no longer make a normal Roth IRA contribution. There are ways to make a non-deductible IRA contribution and then convert that, at least all or part of that, to a Roth after the original contribution is made. And we can discuss that. We're glad to discuss that further with you if you'd like. The amounts to put into a Roth, they remain at $5,500 and $6,500 for those that are 50 and older. Okay. I'll touch on a few other things. The estate and gift tax exemption for 2015 is $5,430,000 this year. The rate remains 40%, and that's so the state. We're seeing, of course, over the last few years that fewer and fewer people are focused on the estate tax because of where the exemption is. They're much more concerned about items such as capital gains taxes and how to save taxes in that realm. And certainly from a tax planning standpoint, our firm is very keen on all these rules and would be glad to help you address your own situation with regard to tax planning as well as the tax preparation. When we talk about the state tax, I said it's 40%. The gift tax exclusion stays the same, and that's $14,000 per donee. Okay, so you can give away $14,000 this year if you'd like, and you don't have to worry about filing any taxes, and the person that gets the money does not have to worry about including that in their income tax return. If you give away more than that, the $14,000, then you will have to file a gift tax return. The donor will have to file a gift tax return, but it's likely that he would not have to pay gift tax at that time. One thing that does pertain to business, I've focused a whole lot on the individual, but this does affect small business people, and I would be remiss if I didn't mention this. And that is that in December of 2014, Congress finally passed and was signed by the President that the Section 179, the treatment of expensing asset purchases, was passed with reaching back to January 1st of 2014. It looked like we were going to close the year with only being able to expense $25,000 in assets, but the Congress, when they passed this, they raised that or kept it at $500,000 at this point. So for those small business people or those that are investing or doing planning at that time, it made it difficult for planning because of Congress acting so late. But for those that did spend above the $25,000 in machinery and equipment, they will be able to expense those in the current year, generally speaking. Okay. Now, going into 2015, however, this matter will have to be addressed again by Congress. They only approved it for 1 year. So in 2015, again, only $25,000 of assets qualify. This is down from the $500,000 from 2014. And also we have the bonus depreciation rules of 50%. They've lapsed at the end of 2014. And so the lawmakers are going to have to find time in 2015 to address these expired provisions. And we're also looking for the beginning of laying the groundwork for some fundamental tax reform. So, in summarizing this, I've got a couple other things to discuss. Is that coming back to the health reform law, the Supreme Court could throw a wrench into this situation. They're going to tackle the issue of whether the health premium tax credits were limited to those who buy coverage on a state-run exchange. Now, here in the state of Indiana, they do not have a state-run exchange. A decision against the government would nix the credits to buyers of insurance on exchanges run by the federal government. And so the Supreme Court has this action to take. It's probably right now scheduled for June. If their action could weaken the employer mandate, because an employer's ability for the fine is tied to the employees receiving a credit for insurance bought on an exchange. So we'll be watching Congress and the court closely, and certainly, Jeff, I'll be glad to report in the future on any developments in this long-running matter with the Affordable Care Act. I would like to take just a moment to also mention some legislation that passed as recently as December the 4th of 2014, particularly for those individuals that have a family member that has a disability. The ABLE, A-B-L-E, savings account was passed. This is a tax-deferred savings account. ABLE stands for Achieving a Better Life Experience, and this is for the disabled. This is similar to a 529 plan or an education plan, where you put the money in and the earnings are tax-deferred, and you can put in pay-ins. You can put in a non-deductible pay-in of up to $14,000 a year, and this is for any person that is blind or disabled before the age of 26. The payouts on such a plan, they're going to be tax-free if they're used for housing, transportation, education, job training, those types of expenses. Now, to qualify, and I'll just elaborate on this just a little bit, is to qualify, you must get, that individual must receive SSI or SSDI, and they have to be approved for that. And so if you have a child or dependent that is it looks like that they're going to need that, this is something that should be taken up with the Social Security Administration right away, so that you can begin to reap the benefits not only of the SSI and SSDI, but would qualify that person to set up an ABLE savings account. But again, these ABLE accounts are similar to college savings plans, what they are. This account does not supplement, it supplements, but it does not replace the Medicaid or Social Security or private insurance. And it doesn't jeopardize the qualifications. If somebody's on Medicare or Medicaid, it doesn't jeopardize, let's just say if you have grandparents, or let's say if somebody could build, I think the limit right now is $100,000 in these accounts. So if you have other relatives that want to put into this, that would not jeopardize or put them in any kind of peril as far as losing their government SSI or SSDI. So, and we're glad to help you with any questions you may have on that. This is a brand new law that is not very well, is just coming out, and because it's somewhat of a niche for those that do have disabilities in the family, then we can help with that if you'd like. I'd like to turn my attention to something else now. We, as Jeff mentioned, we have offices in Plymouth and in Valparaiso. We have full staffs in both of those locations. We have also limited staffs in the locations of Maryville and Frankfort, Illinois, a far south suburb of Chicago. And for that, we want to reach out to the communities and make an effort to, if you're looking for help with your taxes or accounting, we'd like to see you. We'd like you to call, make an appointment. And by so doing, I want to have a little bit of a program that I would like to offer those that would have an interest in having the work done through Gatlin. If you certainly if you're a current client and you refer a client to us, certainly we'd have to have a few questions with that client, but we'd be glad to talk with them. But what we're going to do is we're going to have a gift here at the end of tax season. And the way it would work is that the gift will be an iPad. And so anybody that refers business to us, a new client, if they come in February, basically it's going to be on a ticket system where they would be given, if they have all their information in here to do their taxes, in February they would get 3 tickets. If they bring it in March, they would get 2 tickets. In April, they get 1 ticket. The more tickets that are accumulated, obviously, by any individual, the better chance he has of winning the prize at the end of the tax season. And let me add this further to you. If you refer a client to us, and you will also receive tickets for that effort. We're doing something called a Good Cause Dollar Match program. That this is basically, in addition to our drawing for the iPad, where you get the 3, 2, or 1 tickets. When you bring us your taxes during those months, we will also donate for $1 for each ticket. And it's going to go this year to the Opportunity Enterprises, which is a nonprofit organization in Valparaiso, Indiana, for those that have disabilities. And so a wonderful organization. They have group homes. They have 24-hour service at those group homes. They have workshops where they do shredding. They do a lot of these individuals are involved in boxing jewelry and a variety of tasks. And so this is a very worthwhile cause. And so Gatlin CPA Group is going to donate $1 for every ticket that is given out. So I hope that gives you an initiative, dual cause for coming in. Certainly, we believe that we can do a wonderful job for you. We're fortunate in the individuals and the companies that come to us. We have a long track of people who stick with us once they're here, and I'm thankful for that. And so you have the ability to come to a company that's here pretty solid in each of these communities and can service your needs both business-wise and individual-wise. We have a number of CPAs on our staff. And also at the same time, you could be a part of an opportunity to not only win a prize, but give to an organization such as Opportunity Enterprise. That's all I have for today, Jeff. I hope that if there's any questions, I'm glad to take those at this time.
Sure, Harold. I don't see any right now, but let's do this. If give out the contact numbers for the different offices, and maybe we can start on east going west. If you're in the Plymouth area or surrounding area, the best phone number to get a hold of them or you?
That would be 574-936-5211.
Okay.
And then
Valpo?
Valparaiso would be 219-462-7544. And then in Maryville, it would be 219-464-4672. And then in Frankfort, Illinois, would be 815-641-3501.
Great. And if somebody wants to send you an email, what's your best email address there?
The email address, the best email to get directly to me would be hgatlin@gatlincpa.com. That's HGATLIN at GATLINCPA.com. Our webpage is gatlincpa.com.
Great.
And that has the numbers and the locations and so forth. Okay.
Super. Harold, thanks so much for being on the call. And again, thank you listening, whether it's live or on the replay. This has been Harold Gatlin of Gatlin CPA Group with tax and accounting strategies for 2015. Thanks, everybody. We hope to talk to you soon.